We need to talk about it. We need to talk about the fact that everything seems to be becoming very expensive. That's the trend that I'm seeing over the past few months, is that everything is going up in price. We have my passive income portfolio, which I created to generate another stream of income for me to be able to subsidize my living. And this portfolio has been performing really well. Things have been going up in price. In fact, it's performing so well that when I look through my holdings and possible investments, it's becoming increasingly difficult to find good companies that are undervalued. And this isn't a problem exclusive to the stock market. Looking at the housing market right now is insane. Home prices have gone up like crazy. CNBC notes that one of the most searched terms right now is, when is the housing market going to crash? That term has been searched 2,450% more in the past month than the months prior. That's because home prices have gone up so much over the past couple months. We also have some discouraging headlines and studies from economists saying that young people stand to make dismal returns on their investments, specifically in the stock market. Why? Because the price is so high. And when the price is too high, your expected future return is lowered. This is the issue that economists are seeing right now. And we can even look outside of the stock market, outside of real estate, and we can look into things like alt investments like Bitcoin. Bitcoin's in the same situation. It's at an all-time high above $63,000 a coin. 1 year ago, it was $6,000 a coin. Bitcoin has gone up 10 times in value in 1 year. And then we can even look outside of things like Bitcoin, the housing market, the stock market, into things like Pokemon cards, and these have spiked up in price as well. A holographic Charizard Pokemon card is selling for over $300,000. There's some of them that have sold for $350,000. This is incredible what we're seeing. Everything seems to be becoming very expensive, and the question is, what do we do in that situation? I'm going to answer that question in this video. Now, before we get into all of this, I have to give a quick shout out to the growing number of Patreon members. I appreciate your guys' support a lot. And if you haven't joined the Patreon, or at least tried it out, there's a link in the description. You're not locked into anything. You can try it out for free for a couple weeks, and you get access to a lot of exclusive stuff, like a Discord community, different episodes, clubhouse meetings, as well as portfolio tracking software. So we've had some really good responses from the Patreon. Most people that join it really seem to like it. So if you want to try that out, there's a link in the description, or it's patreon.com/Joseph Carlson. Now let's go ahead and jump right in. For people new to the channel, this is my passive income portfolio. It's a real portfolio with real money. I show the progress of it every single week, week after week. So if you want to see the progress of this portfolio, make sure you subscribe to the channel. Now the goal of this portfolio is in the name, to grow a stream of passive income that grows over time and continues to compound, and someday I can live off of that passive income. That's the goal of it. Now, the way that I try to accomplish this is by investing in companies that are diversified, that are undervalued, and they pay me a stream of revenue. They pay me a stream of dividends. The issue that I'm having right now is what I outlined at the beginning of this video. It's becoming increasingly difficult to find value. If we look in companies like fintech and banking, we have JP Morgan, Bank of America. These stocks have gone up like crazy. They're no longer, in my opinion, deep value. They're not really undervalued. People are paying a lot of money for these banks. If we look in tech and cloud computing, we have companies like Apple and Microsoft, and we have software companies like Adobe. All these companies have gone up in value as well pretty dramatically over the past 6 months, and I no longer believe they're trading at substantial discounts. We can look in the consumer category. We have companies like Disney, Costco, Home Depot, Nike, Comcast, and Target. Companies that are expensive, 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 expensive. That's what we're seeing right now. Everything is going up in value so much that everything that you're buying is likely expensive in historical terms. Now, this isn't just an issue with those companies or those stocks that I'm picking out. I'm not cherry picking data. This isn't just an issue with my portfolio. This is an issue with the entire market. If we look at the S&P 500, large cap companies on a forward earnings basis, right? The forward PE ratio, the average PE ratio right now is 22.5. You might notice something if you look at the graph over the past 15 years. You might notice that the S&P 500 is more expensive right now than it has been over the past 15 years by a large extent. On average, it's usually somewhere around 15 or 16, and it's trading at a 22.5. That's a substantial difference. Large cap companies are expensive historically speaking. We can also look at mid-cap companies. Mid-cap companies are trading on a forward PE ratio basis of 19.8, which again is more expensive than it has been over the past 15 years by a pretty substantial margin. And we can even look at small cap companies. Those are trading at a forward PE ratio of 20.1. Again, more expensive than they have been for the past 15 years on average. Everything from small cap companies, mid cap, large cap are trading at higher valuations and higher multiples based on their future earnings than they have historically over the past 15 years. Okay, well, Joseph, we know that companies like Disney and Costco and Home Depot and other large cap companies are trading at historically high valuations. Well, maybe we should just kind of avoid the stock market and we can invest in real estate. Let's go ahead and look at the housing market. The housing market's in the same situation. If I'm trying to buy a rental apartment or some type of income property, by some estimates, the housing market's more expensive than the stock market. If I want to try to buy a home, I'll probably be in a bidding war. There's an economist saying, quote, "We've got an acute shortage of supply on the market for sale at the same time that record low mortgage rates are driving the appetite to buy by millennials and Gen Xers." So we have a shortage of supply in houses and a huge appetite for people to buy houses. At the start of this month, 42% of homes were selling for more than their list price, according to Redfin. So they're selling over the price that people are listing them, and people are listing them probably pretty enthusiastically at high prices. They say, quote, "The housing market is more competitive than we've ever seen it." Ever. Throughout all of history, the housing market is the most competitive that people have ever seen it. All right, Joseph, well, we know that the housing market might be a little bit expensive right now, maybe not the best time to buy a rental property, so maybe it's even more expensive than our stock portfolio. Well, we can look at other types of investments. We have Bitcoin hitting an all-time high. It's at $63,000 a coin. 1 year ago, it was trading at $6,000 a coin. There's a lot of enthusiasm priced into Bitcoin. And even companies surrounding Bitcoin are trading at enormous valuations. Coinbase, the cryptocurrency exchange, is going to be valued as much as $100 billion. This is a new company, and they estimate the value will be on IPO day $100 billion. And I bet you the price will go up from there. I bet you this is going to be an IPO that has so much demand, it'll go up substantially the first day. So just to recap the situation we're in, we know that stocks are selling at a historical high if you compare the forward earnings to the past 15 years. We know that the housing market is at an all-time high. There's incredible demand to own homes and not many homes to go around. And we know that there's a lot of enthusiasm into crypto investments. The price for Bitcoin has gone up 10 times in the past year, and companies like Coinbase that revenue a few billion a year are selling for $100 billion. Maybe let's look for other investments outside of these. Maybe we'll look at Pokemon cards. We know that those are pretty hot right now. Those are going around. They're selling for $300,000 plus. Well, according to the website PokeMarketCap, we seem to have missed the ball on that as well. Just 1 year ago, a grade 10 Charizard card was selling for $36,000. And now they're selling for over 10 times that value at $350,000 plus. So again, another thing that's enthusiastically priced and has gone up 10 times in value in the past 1 year. So we know with all of this data, across all different investment opportunities, things are relatively expensive right now, historically speaking, and this has led to a lot of very negative headlines, very discouraging headlines from economists like this one. Young people stand to make dismal returns on their investments. That's the headline from The Economist. Young people stand to make dismal returns. This is the outlook that the economists are giving us right now, okay? For the younger generation, this is how incredibly discouraging and incredibly negative their outlook is. They say, having been born into the most prosperous period in human history, today's youngsters have much to hope for. Okay, well, what do they have to hope for? Economists, let's go ahead and hear it. But they also have much to fear as well. On top of an inherited climate crisis, okay, we have a climate crisis. The young will have to suffer the economic consequences of a pandemic. For Gen Z, those who are born after 1997, this could mean higher rates of unemployment. Okay, so we have high rates of unemployment, lower earnings, higher taxes to pay off the pandemic-era debts, and add to this unhappy list of less noticed but no less serious problems, Gen Z's dismal financial prospects. According to Credit Suisse's latest Global Investment Returns Yearbook, Gen Z's earnings from stocks and bonds will be significantly lower than those of previous generations. That's what they're forecasting. This is what the economists are telling us, and they give us an illustration of this. Gen Z on average is going to earn 3% on stocks moving forward. 3% annualized returns, where baby boomers on average earn 7%. So Gen Z is going to earn less than half on stocks than what baby boomers did. That's what the economists are currently telling us. Well, that's no fun. That's not exciting to read. That's pretty discouraging. This is economists predicting that we're going to essentially have no returns in our future, that we're going to have 3% portfolio returns with stocks, and that we're going to have taxes and inflation that will eat away at those returns. So essentially, we're not going to earn any money with stocks going forward. That's what economists are predicting. Now, when I read doom and gloom like this, I like to turn to a few people that I respect a lot. One of those individuals is Peter Lynch. This is one of the best investors to ever live. In my mind, he rivals Warren Buffett. He crushed the market for 12 years straight, over doubling the returns, and he did so with a very simple investment strategy. And I think that part of the reason Peter Lynch was so good at investing is because of how optimistic he remained all the time. He was a very optimistic person. Listen to him go through examples of all the different reasons through history that the market wasn't going to do well, that there was different reasons that you should stay out of the market.
Then the Mideast was going on the world. Remember that one? The Mideast was going on the world. They weren't going to buy our bonds, and the market crashed and we're going to have a depression.
The Middle East? The Middle Eastern War was a big reason why investors wanted to stay out of the market. It was a scary time going on. People weren't going to buy our bonds, and maybe the market was going to crash. So you better stay out of the market.
Then Japan was going on the world. Remember that one? Japan was going to have all the assets, and they weren't going to buy our bonds, and we're going to have a depression. Within 3 years, the Nikkei Dow had gone from 40,000 to 16,000. The banking system was in trouble, and people said Japan was going to collapse, and we're going to have a depression. I mean, people had, on their prayer list at the end of the day, they had eliminated crippled children and Mother Teresa, they're praying for Japan. I mean,
Japan was a big reason that people stayed out of the market. They were concerned about Japan's economy.
Country with a 15% savings rate, it's something bizarre, Commercial real estate, global warming, And I think as the older you get, the more nervous you get about these things. I think it's very valuable. I think while younger people are better investors is they're not worried. They haven't heard about all these crises.
He says he thinks that younger people are better investors because they're not so concerned with everything going on in the world. I see that changing over time. From when Peter Lynch was in his prime, there wasn't as much media and as much consumption by younger people with all these world events going on. But I think, generally speaking, not being concerned about all this different stuff going on does make you a better investor. There's a benefit to investing in being naive, and Peter Lynch describes that benefit.
And they're with children. I think if you don't have any kids, you got to rent some kids for the weekend. Get a 7-year-old and ask him if he knows about the money supply, how fast it's growing. Ask him if he knows about the shape of the yield curve is the wrong shape of the yield curve. Or that we're 48.3 months into the economic recovery and the average recovery lasts 52.3 months. Ask an 8-year-old if they know about that. 8-year-olds have a very high expectation about the next 20 years. That's what you need to do.
8-year-olds are optimistic. They have high expectations about the next 20 years. They just think things are going to go great. They're not worried about all the different details that adults are.
The more you get away from 8-year-olds, the more you get away from 11-year-olds, the more you start reading these crazy things you read over the weekend. In fact, from 1955 to 1985, the stock market went up a grand total of 1,000 points, but it was down 800 on Mondays. So it was therefore up 1,800 on non-Mondays. It wasn't an accident. The stock market went down. October the 19th, 87 was a Monday. People over the weekend become economists and portfolio strategists.
People over the weekend become economists, which makes them concerned about the future, which typically leads to lower returns because they stay out of the market. They're too fearful to go in and invest in great companies. Peter Lynch, very similarly to Warren Buffett, acknowledges what he doesn't know and what he doesn't concern himself with.
So I have no idea when the market's going to go down and no idea when it's going to go up. I'm totally shocked. The market was 4,000 2.5 years ago. A little while ago it's 8,000. I had no idea about this. Very surprising to me. But I'll guarantee you the market will be a lot higher in 15 years. It'll be a lot higher in 25 years.
Similar to what Warren Buffett says on the subject, Peter Lynch doesn't know what the market's going to do in a year or 2 years, but he knows that in 15 years or 20 years, it's going to be a lot higher than it is today. And he also goes on to criticize economists, saying that they are not accurate with their forecasts, and many times they're extremely pessimistic. So he doesn't focus on it. He doesn't care about all this economic data. He focuses on investing in good companies at good valuations. So even though I have all this scary economic data to look at of inflated asset prices and economists saying that we're going to earn only 3% per year on our investments, I choose to listen to Peter Lynch. I think that if you're optimistic, if you listen to people like Peter Lynch and buy good companies at reasonable valuations, I think you'll earn a lot more than 3%. And honestly, I don't believe people have a clue of what direction the market's going to go. Just this week on CNBC, we have Tom Lee from Fundstrat predicting that we're going to have, quote, a face ripper of a rally in the stock market. Apparently, we're going to have a rally so fast, so quick, that it's going to rip your face clean off. And then on that same network, literally just a couple days later, we have Savita, a Bank of America analyst, predicting that you're going to get almost no returns with the S&P 500. So we have one person predicting a face-ripping rally and another person predicting almost no returns in the future. This should give you an insight into how well people can predict the future. So I intend to follow the advice of Peter Lynch and ignore these people making these predictions about the stock market. I'll continue to buy companies trading at undervalued prices that offer good cash flow in the future, and I'll be building my cash flow over time. So if you want to follow the progress of this, like I said, just subscribe to the channel. I'll have more updates and insights for you. And if you want to bring your membership to the next level, you can consider checking out the Patreon. It's a lot of fun. There's a link in the description. Other than that, I appreciate you guys watching, and I'll check in with you next time.